Hey fellow stock explorers, welcome back to another deep dive. Today we're looking at SoFi. This company's making waves in the financial world, and we're going to explore how they're building what some are calling a financial supermarket, and why that might have traditional banks feeling a little nervous.
Well, what's fascinating about SoFi is their ambition. They're not just offering like a loan here or a credit card there.
Right.
They're aiming to be the single destination for all your financial needs.
Okay, so not just picking a product off the shelf, but like walking into a giant financial superstore.
Exactly. Imagine you need a checking account, want to invest some savings, maybe even refinance student loans. You can do all of that with SoFi. They've got robo-advisors for hands-off investing, their own credit cards, even protection products like insurance. It's this breadth that makes them really different.
So convenience is a big part of it. But is that really enough to disrupt the giants of banking? I mean, haven't they tried to modernize too?
They have. But SoFi's approach is fundamentally different. It's built around what they call the financial services productivity loop.
Okay. Tell me more about that.
It's about using technology to make everything seamless and connected. The more you use SoFi, the more personalized their recommendations become, the more likely you are to use even more of their products. Traditional banks with their branches and legacy systems, they just can't replicate that kind of integrated, personalized experience.
So it's like a flywheel effect, building momentum as they go.
Exactly.
Okay, I'm starting to see the appeal.
Yeah.
But does this translate to actual success? What do the numbers say?
The numbers are pretty compelling. They just hit a major milestone, over 10 million members.
Wow.
That's 9 times their size just 5 years ago.
That's incredible.
And it's not just about quantity. Their financial performance is backing up the hype. Their last earnings report showed record annual revenue of $2.6 billion, a 26% jump year over year. Plus, they hit GAAP profitability for the entire year, bringing in $499 million in net income.
Whoa. Those are serious numbers.
Yeah.
And with their adjusted EBITDA at $665 million,
Right.
a 26% margin, it seems like they're figuring out how to make money while they grow. But growth and profit are one thing. What really makes SoFi unique in this crowded fintech space?
One word: innovation.
Okay.
They're constantly pushing boundaries and offering features you won't find at your typical bank.
Give me an example.
For example, they offer early access to IPOs for investors, giving everyday folks a chance to get in on the ground floor of exciting companies.
I've heard about that. It used to be that only the big players could get those early investment opportunities.
Exactly. And they're going even further, offering unique investments like alternative assets. They even have the Cosmos Fund, with sole exposure to SpaceX.
Wow.
Not your grandpa's savings account, right?
Definitely not. So they're shaking things up for individual investors.
Yeah.
But what about their tech platform? They talk a lot about that. But how does it go beyond serving individuals?
This is where it gets really interesting. They're using their technology to power other businesses, too. Banks, fintech startups, even big consumer brands. A great example is the U.S. Treasury picking SoFi's Galileo platform for their Direct Express program. This program uses prepaid debit cards to deliver federal benefits to 3.4 million people.
Wait, so the government is trusting SoFi's tech to handle millions of people's benefits. That's a huge vote of confidence.
It is. It shows their technology is reliable and robust enough for even the most critical applications. SoFi isn't just building a financial platform, they're building the infrastructure for a new era of financial services. It's about powering the whole ecosystem.
Okay, that's a big vision. But can they pull it off? What's SoFi's game plan for the future?
Well, for 2025, they're projecting 28% member growth, aiming for revenue to exceed $3.2 billion. They're also continuing their focus on those innovative investments we talked about and launching a new fee-based SoFi Plus subscription.
So they're not resting on their laurels. They're pushing forward on all fronts.
Right. And they're expressing strong confidence in hitting both their medium-term and long-term financial goals. It seems they're betting big on their model and on their ability to keep innovating. But whether they can truly reshape finance the way they envision, well, that's a story that's still being written. So you're looking at SoFi as a potential investment. What's standing out to you so far?
I have to admit, their growth is eye-catching, hitting 10 million members. It's huge. But are they just throwing money at marketing? Or is there something deeper driving that engagement?
That's the key question, right? And this is where SoFi's focus on financial health for its members becomes really interesting. It's not just about opening accounts. It's about actually helping people improve their financial lives.
Okay, give me an example. How do they actually do that?
Think about student loans, a huge burden for many people.
Right.
SoFi members have collectively paid down a staggering $33 billion in credit card debt. Yeah. And borrowed $117 billion to reach their goals, including $44 billion in refinanced student loans. They're not just providing access to financial products, they're actively helping people get out of debt and achieve their financial goals.
So they're not just a bank. They're almost like a financial coach in some ways.
That's a good way to put it. They're offering tools and resources to help people make smarter financial decisions. And it seems to be working. Their members have also earned over $1 billion in interest on their savings through SoFi.
Okay, so their member-centric approach seems to be resonating. But let's talk about their product innovation. Are they just iterating on existing financial products? Or are they coming up with genuinely new things?
They're doing both. They've got their robo-advisor platform, which makes investing more accessible for those who don't want to manage their own portfolios. And they're tapping into the growing interest in alternative assets, recognizing that many investors are looking beyond traditional stocks and bonds. Remember that Cosmos fund giving investors access to SpaceX?
Yeah, that one was definitely a head-turner. And they're letting regular folks get in on IPOs,
Right.
which used to be an exclusive club for Wall Street. It feels like they're actively trying to democratize investing.
Exactly. They're breaking down barriers and giving everyone a chance to participate in wealth-building opportunities that were previously out of reach for most people.
That's a powerful message. But let's get back to their tech platform for a moment. We talked about how it powers other businesses, but what makes it so special? Why are companies choosing SoFi over other tech providers?
One reason is they've built their technology with flexibility and customization in mind.
Okay.
It's not a one-size-fits-all solution. They can adapt their platform to meet the specific needs of different businesses, whether it's a bank wanting to modernize its digital offerings or a consumer brand looking to launch its own financial products.
So they're like the Legos of fintech, providing the building blocks for others to create their own unique structures.
That's a great analogy, and they're constantly iterating and improving their existing products too.
Right.
For example, they've expanded money movement options for SoFi Money users and introduced new SoFi credit card offerings with tailored benefits.
So they're not standing still. They're constantly moving, evolving, trying to stay ahead of the curve.
Right.
But with all this going on, are they spreading themselves too thin? Is there a risk they're losing focus?
That's a valid concern with any company that's expanding rapidly into new areas. But what's interesting is that their core mission, helping people reach financial independence, seems to tie all their different initiatives together.
Right.
Whether it's through lending, investing, or their tech platform, they're always striving to empower their members financially.
So it's not just growth for growth's sake. There's a deeper purpose driving their expansion.
Exactly. And that purpose seems to be resonating with both customers and investors. But let's not get ahead of ourselves. We've talked about the big picture, but we need to look closely at their financials to see if their performance matches their ambition.
Okay.
Are you ready to dive into those numbers?
Bring it on.
Yeah.
I'm curious to see if the details back up the hype. Let's talk numbers. Where do we start?
Let's zoom in on their fourth quarter performance, as that often gives a good snapshot of where a company stands heading into the new year.
Okay, so Q4 of 2024. What were the highlights? What jumped out at you?
They achieved record adjusted net revenue of $739 million, a 24% increase year over year and a 7% jump from the previous quarter. This was driven by growth across all their business segments.
Hold on, growth across all segments. That suggests they're not just reliant on one product or service.
Exactly. They're building a diversified business, which is a good sign for long-term stability.
Makes sense.
Now remember, we talked about them making money from more than just loans. Well, their non-lending segment, which includes their financial services and tech platform, contributed a record 49% of their total adjusted net revenue in Q4.
Wow, almost half their revenue from sources other than lending. That's a big shift from the traditional banking model. It seems like they're proving that their tech platform can be a real moneymaker.
It is, and this diversification is a key part of their strategy for achieving higher returns and building a more resilient business.
Okay, color me intrigued. Let's break it down further. What's driving that non-lending revenue growth?
Their financial services segment is firing on all cylinders. It generated $257 million in net revenue for Q4, a whopping 84% increase year over year. This growth is fueled by the success of products like SoFi Money and SoFi Invest, as well as their expanding range of offerings.
So people are really using those products, not just opening accounts and forgetting about them. But revenue's one thing. Are they actually making a profit from these services?
Absolutely. Their contribution profit for financial services soared to $115 million in Q4, a remarkable 4.6x increase year over year, and their contribution margin for the segment also improved substantially, reaching 45% compared to just 18% in the same period last year.
Okay, those margins are impressive. It shows they're not just growing, they're becoming more efficient and profitable as they scale. But where exactly is that financial services revenue coming from? Is it all fees, or is there something else in the mix?
It's a combination of factors. They generated $160 million in net interest income for this segment in Q4, mainly from the growth of consumer deposits,
Okay.
showing that their strategy to attract and retain deposits is paying off. But they also had explosive growth in non-interest income, which hit $96 million, a 3.2x increase.
Wow, that's huge. What's driving that surge in non-interest income?
It's a mix of things, including their loan platform business, interchange fees from their SoFi Money and credit card products,
Yeah.
brokerage revenue from SoFi Invest, and referral fees.
So they're creating multiple revenue streams within their financial services segment. It's like they're building a diversified portfolio of income,
Right.
which makes them less reliant on any single product or service.
Precisely. And their loan platform business is becoming a significant contributor. It brought in $63 million in fees during Q4, showing the growing demand for their loan origination and servicing capabilities. And they're already off to a strong start in Q1 of 2025, recently agreeing to initial terms with Blue Owl Capital Funds for up to $5 billion of personal loans over the next 2 years.
Hold on, $5 billion. That's their largest loan platform agreement to date.
It is.
It seems like institutional investors are really buying into SoFi's model.
They are, and this deal further solidifies their position in the growing loan platform market. It seems like they've cracked the code on how to connect borrowers and investors in a way that benefits everyone involved.
Okay, I'm getting the sense that their financial services segment is a powerhouse. But what about their tech platform? Is it contributing as much as they'd hoped?
It's delivering steady growth, even if it's not as explosive as the financial services side. They brought in $103 million in net revenue for their tech platform in Q4, a 6% increase year over year.
Okay, 6% might not seem like much compared to the triple-digit growth we saw in financial services. Should we be concerned about that?
Not necessarily. It's important to remember that their tech platform is still in its relatively early stages of development, and they're attracting new clients and diversifying their revenue sources. Within this segment, they achieved a healthy 31% contribution margin for their tech platform in Q4, pulling in a $32 million profit.
So it's profitable, which is a good sign. But are they attracting the right kind of clients for their tech platform? Are we talking about small startups or bigger, more established players?
They're attracting a diverse range of clients, including major consumer and commercial brands, as well as large enterprises in Latin America.
Okay.
These recent client wins show that SoFi's technological capabilities are being recognized, and their value proposition is resonating with businesses that want to improve their financial service offerings.
It's almost like they're becoming the Intel inside of Fintech, powering the back-end systems for a wide range of companies.
Exactly. And these partnerships are expected to fuel SoFi's revenue growth in the coming years, as these clients fully integrate SoFi's technology into their operations.
So it's not just about the immediate revenue. It's about building a long-term foundation for growth.
Right.
But with all this focus on their non-lending segment, are they neglecting their core lending business?
Not at all. Their lending segment is still a major revenue generator, and they're seeing strong growth there too. They pulled in $423 million in adjusted net revenue for lending in Q4, a 22% increase from the same period last year. This growth was mainly driven by a 31% year-over-year increase in net interest income, which hit $345 million.
So they're attracting borrowers, and they're making money from those loans. But are they taking on too much risk as they expand their lending operations?
That's a critical question with any lender, and it's something investors need to watch closely. But so far, their credit performance has been impressive. Their personal loan borrowers have a weighted average income of $158,000
Okay.
and a weighted average FICO score of 744. That suggests they're lending to high-quality borrowers who are likely to repay their loan.
Those are some reassuring numbers. So they're not just chasing growth at any cost. They're maintaining strong underwriting standards.
Exactly.
But let's dig a little deeper. How are their loans performing in terms of delinquencies and charge-offs? Are there any red flags there?
Actually, their credit trends have been improving.
Okay.
Delinquencies peaked in the first quarter of 2024, but they've been trending downwards ever since.
That's a positive sign. It shows they're adapting to changing market conditions and keeping a close eye on the health of their loan portfolio.
Exactly, for their personal loans. The on-balance sheet 90-day delinquency rate was just 55 basis points in Q4, down slightly from 57 basis points in Q3.
Okay.
And their annualized charge-off rate for personal loans also declined to 3.37% in Q4, down from 3.52% in the prior quarter.
So they're seeing fewer late payments and fewer loans going bad.
Mm.
That bodes well for their profitability and their ability to continue lending responsibly.
It does, and remember, they strategically sold off some of their late-stage delinquent personal loans during Q4, which helped improve those numbers even further. If they hadn't sold those loans, their estimated all-in annualized net charge-off rate for personal loans would have been about 4.9%, compared to 5% in the prior quarter.
So they're proactively managing their portfolio.
Yeah.
Which is what you want to see from any lender.
Right.
But what about student loans? Those can be a bit riskier, especially with so many borrowers struggling with debt. How are their student loans performing?
The student loan portfolio is also holding up well. Their on-balance sheet 90-day delinquency rate remains stable at 12 basis points in Q4, indicating that those loans are performing consistently.
Yay.
And their annualized charge-off rate for student loans actually decreased to 62 basis points in Q4, down from 69 basis points in the prior quarter.
So even their student loans are showing improving credit trends. It seems like their underwriting and risk management processes are pretty solid, regardless of the loan type.
It does, and all this data supports their projections for future loan losses. They've been estimating a maximum life of loan loss of 7% to 8% for personal loans. And their actual credit performance is currently trending below those assumptions.
So their loans are performing even better than they expected. That's a good sign for investors who are concerned about credit risk.
It is, and it shows that they're being realistic and conservative in their assumptions. They're not just painting a rosy picture. They're backing up their projections with data.
Okay, I'm feeling more confident about their lending operations, but we need to shift gears and talk about something that often confuses people. Fair value marks. How does SoFi value their loans? And what should investors know about their approach?
So SoFi marks their loans at fair value each quarter, which means they're taking into account various factors to determine the current market value of those loans.
Okay.
This includes things like the weighted average coupon, the constant default rate, the conditional prepayment rate, and importantly, the discount rate.
Okay, the discount rate. That one often throws people off. What is it, and why does it matter for SoFi?
The discount rate reflects the time value of money. It's used to calculate the present value of future cash flows from those loans. SoFi uses benchmark rates and spreads to determine their discount rate, ensuring that their fair value marks align with current market conditions.
So they're not just making up a number. They're using real market data to determine the value of their loans.
Right.
That's reassuring. But how do those fair value marks actually fluctuate? What are the key drivers there?
Well, at the end of Q4, their personal loans were marked at 104.9%, down 80 basis points from the previous quarter. This change was mainly driven by a 51 basis point increase in the discount rate, which rose to 5.29%.
Okay, so rising interest rates are pushing down the fair value of their loans.
Right.
That makes sense. But how much should investors worry about these fluctuations? Are they material to SoFi's overall financial health?
While fair value marks are important, it's crucial to remember that they don't always reflect the actual cash flows SoFi will receive from those loans.
Right.
And importantly, SoFi has a hedging strategy in place to mitigate the impact of interest rate changes on their fair value marks. Any fair value impacts resulting from increasing interest rates in Q4 were almost entirely offset by hedge gains, demonstrating their effective hedging strategy.
So they're being proactive about managing those risks, which is a good sign.
Right.
But what about their student loans? How are those marked at the end of Q4?
Their student loans were marked at 104.1%, down 133 basis points from the previous quarter. This change was mainly due to a 41 basis point increase in the discount rate, which rose to 4.4%.
So similar story as personal loans with rising interest rates driving down the fair value marks.
Right.
But again, it sounds like they're actively managing those risks through hedging.
Exactly. So while it's important to understand fair value marks and how they fluctuate, investors shouldn't overreact to short-term changes.
Yeah.
The key is to look at the long-term trends and how SoFi is managing those risks.
Okay, fair value marks, check. Now let's move on to their balance sheet. What's the overall picture there? Are they financially sound and well capitalized?
Their balance sheet reflects a strong financial position. Their total assets grew by $1.9 billion in Q4, driven by loan growth and increase in other assets, and modest growth in cash equivalents and investment securities.
So they're growing their asset base,
Shit.
which is what you want to see from a company that's expanding.
Right.
But what about their liabilities? Are they taking on too much debt to fuel this growth?
Their total liabilities also grew by $1.5 billion in Q4, mainly driven by a $2.6 billion increase in member deposits.
Yeah.
This shows their SoFi Money product is gaining traction, and they're attracting and retaining customer deposits effectively.
Makes sense.
They're strategically shifting away from more expensive non-member deposits, which they reduced by $1.2 billion in Q4.
So they're becoming less reliant on expensive borrowing and more reliant on customer deposits, which are a cheaper source of funding. That sounds like a smart move.
It is, and it's paying off. They're seeing a significant difference between the interest they pay on deposits and the interest they pay on warehouse lines, which translates to about $500 million in annualized interest expense savings.
Wow.
This favorable funding mix is helping them maintain a strong net interest margin, which hit 5.91% in Q4, a 34 basis point increase from the previous quarter.
So their profitability is improving as they shift to a more favorable funding mix. That's a good sign for their long-term earnings potential.
It is.
But what about their capital ratios? Are they well capitalized enough to withstand potential economic shocks?
Their regulatory capital ratios are healthy, indicating a strong capital position, and their ability to weather potential storms. Their total capital ratio was 16.2% at the end of Q4, comfortably exceeding the regulatory minimum of 10.5%.
They've got a good cushion there. But beyond just regulatory requirements, are they building tangible book value for their shareholders? Are they creating real value over time?
They are. Their tangible book value grew by $465 million sequentially, reaching $4.9 billion at the end of Q4. This includes non-recurring benefits related to deferred taxes, which, while not expected to recur, still represent value retained within the business. Their tangible book value per share was $4.47 at the end of Q4, a significant increase from $3.61 a year ago.
So they're creating tangible value for their shareholders, which is ultimately what matters most.
Exactly.
Okay, their balance sheet looks solid, their lending business is performing well, and their tech platform is gaining traction.
But what about the future? What's their outlook for 2025 and beyond? Are they still optimistic about their growth prospects?
They're entering 2025 with strong momentum and a positive outlook. They're benefiting from favorable conditions, including lower interest rates, a robust job market, active capital markets, and growing brand recognition. They're confident in their ability to capitalize on these conditions and continue delivering impressive growth and profitability.
So they're not just hoping for the best. They're seeing real evidence that supports their optimism.
Right.
But what are their specific plans for 2025? What are they focusing on to achieve that continued growth?
After a year of strengthening their capital base, reaching GAAP profitability, and achieving the scale needed to drive sustained profitability.
They're shifting their focus to accelerating growth. They're planning to reinvest some of their profits back into the business to fuel expansion and capitalize on the massive market opportunities ahead.
Makes sense.
In 2025, they're aiming for an incremental EBITDA margin of around 30%, striking a balance between profitability and growth.
So they're not just chasing profits, they're investing in their future growth potential.
Exactly.
It's a delicate balancing act, but it seems like they're approaching it strategically.
They are, and their financial guidance for 2025 is based on reasonable macroeconomic assumptions that align with current market expectations.
Okay, so they're not just basing their projections on wishful thinking. They're taking into account the broader economic context.
Right.
But let's get down to brass tacks. What are their specific financial targets for 2025? What numbers are they aiming for?
They're expecting to add at least 2.8 million members in 2025, representing at least 28% year-over-year growth.
So they're expecting to keep growing their user base at a healthy clip. But what about revenue and profitability? What are their targets there?
They're projecting adjusted net revenue between $3.200 billion and $3.275 billion for 2025, implying 23% to 26% year-over-year growth.
Okay.
And they're expecting adjusted EBITDA in the range of $845 million to $865 million for 2025, with an incremental EBITDA margin of around 30%.
Those are some ambitious targets, but if they hit them, it would signal continued strong performance and a solid foundation for future growth.
Right.
What about their bottom line? What are they projecting for net income and earnings per share?
They're projecting adjusted GAAP net income between $285 million and $305 million for 2025, with an incremental net income margin of 20%. This assumes a 26% tax rate. They're also expecting adjusted GAAP earnings per share between $0 and $25.27 for 2025, demonstrating their commitment to delivering shareholder value.
Those earnings projections are encouraging,
Yeah.
but are they just focusing on the short term? Or are they thinking about long-term value creation as well? What are their plans for tangible book value and capital ratios?
They're anticipating growth in tangible book value between $550 million and $575 million for 2025, showing they're building long-term value for shareholders. They're also expecting to end 2025 with a total capital ratio above 15%, maintaining a strong capital position to support future growth.
So they're thinking strategically about both the short term and the long term. It seems like they're striking a good balance between growth profitability and long-term value creation.
Exactly.
But what about the immediate future? What's their guidance for the first quarter of 2025? Are they expecting to start the year strong?
They're projecting adjusted net revenue in the range of $725 million to $745 million for Q1 2025, implying continued strong revenue growth. They're expecting adjusted EBITDA between $175 million and $185 million for Q1 2025, reflecting a healthy EBITDA margin and continued focus on profitability. And they're projecting GAAP net income between $30 million and $40 million for Q1 2025, implying a solid start to the year in terms of profitability.
Those are some encouraging numbers for the first quarter. It seems like they're expecting to hit the ground running in 2025. But are there any unusual factors that investors should be aware of when comparing their Q1 2025 guidance to their Q4 2024 performance?
Yes, there are a couple of key differences that impact comparability.
Okay, tell me more.
First, they're assuming a 26% effective tax rate in Q1 2025,
Okay.
compared to an immaterial impact from taxes on pre-tax income. Prior to releasing their valuation allowance, this translates to about $15 million in expected taxes during Q1 2025.
Okay, so taxes will be a bigger factor in Q1 2025.
Right.
What's the other difference?
They typically incur seasonal payroll taxes during the first 2.5 quarters of each year. This means about $10 million in incremental operating expenses in each of the first 2 quarters of 2025.
Okay, so it's important to factor in those adjustments when analyzing their first quarter results. But overall, it seems like they're setting the stage for another strong year in 2025. Their performance in 2024 was impressive. Exceeding expectations and building a foundation for continued success, they've shown they can drive robust growth, achieve profitability, and expand their market presence. Their ambitious plans for 2025, coupled with their strong financial guidance, reflect their confidence in their ability to capitalize on favorable market conditions and continue their upward trajectory. They're well-positioned to solidify their position as a leading innovator and disruptor in the financial services industry.
But let's not just focus on the numbers. What insights can we glean from their recent earnings call? Did they share any interesting perspectives on their strategic direction or priorities?
They did. Their earnings call reinforced their commitment to durable growth and strong returns.
Okay.
They emphasized their dual strategy of innovation and brand building, seeing those as the keys to their success.
So they're not just chasing the latest fad. They're focused on building a sustainable business for the long term.
Right. But did they provide any specific examples of how they're planning to drive that growth?
They highlighted their plan to ramp up investment in their SoFi Invest business, aiming to replicate the success of their SoFi Money product.
So they're doubling down on what's working,
Yeah.
which makes sense.
Right.
But are they just pouring money into existing products, or are they exploring new areas as well?
They're doing both. They're expanding their product offerings, enhancing their tech platform, and boosting their marketing efforts to increase brand awareness.
So they're thinking holistically about growth, not just relying on any one lever.
Right.
But with all this investment, are they still committed to their long-term margin targets? Will this increased spending eat into their profitability?
They reiterated their confidence in hitting those long-term margin targets.
Okay.
30% for EBITDA and 20% for net income.
That's reassuring. It shows they're not sacrificing profitability for growth. They're aiming to achieve both simultaneously.
Exactly.
But what about their funding mix? Are they continuing to reduce their reliance on expensive wholesale funding?
They highlighted their progress in growing their deposit base, which is helping lower their funding costs and boost profitability.
Okay.
They're also strategically using capital markets to manage their balance sheet and optimize their funding sources.
So they're actively managing their balance sheet, not just letting things happen organically.
Right.
It sounds like they're taking a disciplined approach to financial management.
They are. And their earnings call provided valuable insights into their strategic thinking and financial performance. Their commitment to durable growth, innovation, brand building, reinvestment for future growth, and a strong financial position make them a company to watch closely.
They seem to be hitting all the right notes. But let's zoom out for a moment and consider the broader fintech industry. SoFi is clearly a major player, but what are the key trends shaping this space, and what challenges lie ahead?
The fintech industry is booming, driven by technological advancements and changing consumer preferences. Traditional financial institutions are feeling the heat from fintech companies, offering more convenient, affordable, and personalized services.
SoFi is well positioned to benefit from this growth. But what specific trends should investors be aware of? What's on the horizon for fintech?
Several trends are worth watching. First, artificial intelligence and machine learning are transforming financial services, enabling companies like SoFi to automate processes,
Yeah.
personalize experiences, and manage risk more effectively.
SoFi is already using these technologies, but they'll need to keep investing to maintain their competitive edge.
Absolutely.
Second, the rise of digital currencies and blockchain technology is creating new opportunities and challenges.
Right.
SoFi has expressed interest in extending their crypto offerings, and they're likely to explore blockchain technology to enhance their services.
It's a space that's evolving rapidly, and SoFi will need to be agile to stay ahead of the curve.
What else is on the radar?
The growing focus on financial inclusion is creating opportunities. For fintech companies to serve underserved populations, SoFi's mission aligns with this trend, and they're well-positioned to expand their reach and serve a wider customer base.
It's not just about serving the wealthy. It's about making financial services accessible to everyone.
Right.
But with all these opportunities come challenges, too.
Right, of course. The regulatory landscape for fintech companies is evolving, and SoFi will need to adapt to new rules and regulations.
Navigating that regulatory uncertainty will be key to their success. And what about competition? Is it intensifying, or is SoFi pulling ahead of the pack?
Competition in fintech is fierce, with new entrants and established players vying for market share. SoFi needs to keep innovating and building a strong brand to maintain their competitive edge.
Yeah.
But they've got a talented team and a clear vision, which bodes well for their future.
Speaking of their team, let's talk about SoFi's management team. What's their background and what are their strengths?
Their leadership has a proven track record in finance and technology. CEO Anthony Noto brings experience from Twitter and Goldman Sachs. His leadership has been instrumental in their growth and their ability to navigate challenges. CFO Chris Lapointe brings a deep understanding of finance, ensuring their financial operations are sound and efficient. He's key to managing their balance sheet, optimizing funding sources, and communicating their financial performance to investors.
So they've got a strong mix of leadership and financial expertise at the helm. But every company faces risks and challenges. What are some of the potential headwinds that SoFi needs to navigate?
Despite their strong performance, SoFi operates in a highly competitive industry. They need to continuously innovate and attract customers in a crowded marketplace.
So staying ahead of the competition is critical. What else should investors be aware of?
Their business model is heavily reliant on technology, so any disruptions or failures in their tech infrastructure could have a significant impact.
Right.
They need to invest in cybersecurity, data protection, and system reliability.
Technology is their lifeblood, so protecting it is paramount. But what about their lending business? What are the key risks there?
Their lending business is subject to credit risk. Their profitability depends on managing loan losses effectively.
Okay.
Economic downturns, rising interest rates, or changes in consumer behavior could lead to higher loan defaults, impacting their earnings and financial stability.
So they'll need to stay vigilant about credit risk and adapt to changing market conditions.
Right.
What about the regulatory landscape? Is that a concern?
Absolutely. The regulatory landscape for fintech is constantly evolving, and changes in regulations could impact SoFi's business model, costs, or ability to operate in certain markets. They'll need to adapt to new rules and regulations to maintain compliance.
Staying on top of regulatory changes is critical in this space.
Yeah.
And what about their valuation? Is it justified, or is there a risk of a market correction?
Their valuation is high compared to some peers, and their stock price is subject to volatility. If they miss growth targets or encounter unexpected challenges, their stock price could decline. Investors need to weigh the potential rewards against the potential downsides.
SoFi's valuation is a topic of ongoing debate, and investors need to form their own opinions based on their research and risk tolerance.
Right.
But let's talk about their loan platform business, a key part of their growth strategy. How does this model work, And what are the key considerations for investors?
Their loan platform business connects borrowers and loan buyers without retaining those loans on their balance sheet.
Okay.
This helps diversify revenue, reduce risk, and scale operations more efficiently.
So it's a win-win for SoFi and their partners. But what are some of the potential risks or challenges with this model?
The demand for loans from institutional investors can fluctuate.
Okay.
So SoFi's ability to originate and sell loans depends on finding willing buyers. If demand weakens, it could impact their fee income and growth.
So they're not entirely in control of their destiny with this model. What else should investors be aware of?
They need to maintain strong relationships with both borrowers and loan buyers. Their success depends on attracting borrowers and building a network of reputable loan buyers.
It's about building trust and fostering strong partnerships. But what about competition? Are other players trying to muscle into this space?
The loan platform market is getting more competitive. SoFi needs to differentiate themselves through their technology, price, and customer service, and ability to deliver value.
So they can't afford to rest on their laurels. They need to keep innovating and finding ways to stand out from the crowd.
Right.
And what about regulations? Are there any potential hurdles there?
The regulatory landscape for loan platforms is evolving, and SoFi needs to stay compliant. Changes in regulations could impact their ability to operate the platform or generate revenue.
So it's a dynamic space that requires vigilance and adaptability. But overall, their loan platform business seems to be a promising growth engine, with the potential to drive significant value for SoFi and their investors. But let's not forget about their core business, lending. We talked about their impressive credit performance, but how do they actually decide who to lend to? What are their underwriting standards, and how do they assess risk?
Their underwriting standards are data-driven and sophisticated. They consider factors like income credit score, debt-to-income ratio, and employment history. They also leverage alternative data sources, like bank transaction data, to get a more holistic view of a borrower's financial health.
So it's not just about checking boxes on a traditional credit report. They're using a more nuanced approach to assess risk,
Right.
but with interest rates fluctuating and the economy facing some uncertainty. How are they adapting their underwriting standards to account for those changes?
They're constantly monitoring the economic landscape and adjusting their models accordingly. They've tightened their lending standards slightly in recent months to account for the potential for slower economic growth and higher loan defaults.
Okay.
But they're also being careful not to overreact and cut off access to credit for deserving borrowers. It's a delicate balance. But their data-driven approach allows them to make more informed decisions.
It sounds like they're taking a measured and responsible approach, which is reassuring. But let's step back for a moment and think about the bigger picture. We've talked about SoFi's growth, their products, their technology, their financials. But what's their ultimate goal? What are they trying to achieve in the long run?
Their mission is to help people achieve financial independence.
Okay.
They want to empower individuals to take control of their finances, make smarter decisions, and build a better future for themselves and their families.
It's a noble mission, but it's also a very broad one. How do they actually measure their progress towards that goal? What does success look like for SoFi?
They track various metrics, including member growth, product adoption, financial health indicators, and customer satisfaction. They're constantly looking for ways to improve their offerings, expand their reach, and make a tangible difference in their members' lives.
So it's not just about profits and growth. It's about creating positive impact and empowering people. That's a powerful message that resonates with both customers and investors.
It is, and it's what sets them apart from many traditional financial institutions. They're not just focused on maximizing shareholder value. They're genuinely trying to make a difference in the world.
But with all this talk about disrupting traditional banking and reshaping the financial landscape, are they actually a threat to the big banks? Or are they more of a complement to the existing financial ecosystem?
They're both a threat and a complement. They're a threat in the sense that they're offering more innovative and customer-centric products and services, putting pressure on traditional banks to adapt or risk losing market share. But they're also a complement in the sense that they're expanding access to financial services, reaching customers who may have been underserved by traditional banks.
So they're both shaking things up and filling gaps in the market. It's an interesting dynamic that's likely to continue playing out in the years to come.
Exactly, and it's a reminder that the financial services industry is in a period of rapid transformation, and SoFi is right at the heart of it.
So as we wrap up this deep dive into SoFi, I'm left with a sense of cautious optimism. They're a company with a lot going for them: impressive growth, a strong financial foundation, a talented team, and a noble mission. But they also face challenges and uncertainties, like any company in a dynamic and competitive industry.
You've summed it up perfectly. It's an exciting story, but it's still unfolding. Investors need to do their homework, weigh the risks and rewards, and decide for themselves whether SoFi is the right fit for their portfolios.
That's great advice for any investment decision. But one thing's for sure, SoFi is a company worth watching. They're pushing the boundaries of what's possible in financial services, and they're doing it with a focus on the customer. That's refreshing to see.
They're a reminder that finance doesn't have to be complicated or intimidating. It can be accessible, empowering, and even enjoyable.
And that's a message that's resonating with millions of people. And it's what makes SoFi such a compelling company to follow.
So to all our listeners out there, keep your eyes on SoFi. They're a company that's shaping the future of finance, and it's going to be an exciting ride.
And that, my friends, brings us to the end of another deep dive here at Stock Explorers. Be sure to subscribe, like, and activate notifications so you don't miss our next exploration of the companies and trends shaping the future.
Until next time, keep exploring, keep learning, and keep investing in your knowledge and your future.
Thanks for tuning in.